Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive into the numbers that actually matter.
We've got a really interesting one today.
We really do. We are cutting through all the noise today to look at a company that is, I think it's fair to say, the most controversial battleground stock in the entire market right now.
Oh, absolutely. The bulls and the bears on this one are miles apart.
Today, we're breaking down one of the most interesting companies on the market. The former fintech darling that has, well, completely fallen from grace, PayPal Holdings.
A fallen angel if there ever was one.
I mean, we are talking about a stock that is trading at multi-year lows. As we're recording this, it's sitting right around $40.42.
Which is just, it's crazy to think about where it was just a few years ago.
It's unbelievable. And it is trading at a shocking, truly shocking, 7.5 times trailing earnings. On the surface, it just looks like an absolute bargain, a cash machine trading for scraps. But the real question for us as long-term investors is this. Is this one of those classic cigar butt deep value plays where we get to pick up a free puff of profit?
Right.
Or is it a classic value trap where the network effects that built this empire are, unzipping right before our very eyes? That's what we're here to find out.
That's a huge topic, and honestly, the answer isn't as simple as the bulls or the bears want you to believe. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. It's the platform we use for execution because, honestly, the margin rates are low and the execution is top tier. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. We really do appreciate the support.
And while you're there, please like, subscribe, and definitely let us know your questions in the comments. We read them all, and we really want to know where you stand on this ticker.
Now let's get into it. Pillar number 1, the business engine.
Okay, let's unpack this. When most people think of PayPal, they think of that little blue button, the one you click when you're buying sneakers on eBay or clothes online.
Yeah, it's ubiquitous.
It feels like it's the plumbing of the internet. But if we actually look under the hood at the unit economics, something is decoupling.
Decoupling is the polite word for it. I'd argue the engine is completely misfiring. For years, PayPal was just this black box that printed money.
Right.
Investors didn't really need to know how the sausage was made because, the growth was 20% year over year. It was a rocket ship.
You just bought it and didn't ask questions.
Exactly. But now that growth is totally stalled, we have to pry the lid off that black box. And what we're finding is, well, it's a massive degradation in the quality of their revenue.
Okay, quality of revenue. What does that mean exactly?
To understand why, you have to look at the take rate.
Let's pause and define that for everyone. When we say take rate, we are essentially talking about the cut PayPal keeps from every transaction.
Right. Precisely. It's the percentage of every single dollar that flows through their system that stays in PayPal's pocket. And historically, when you use that branded checkout button, the one with the PayPal logo, the company was commanding a take rate of upwards of 2.5%.
Wow. Okay, 2.5%.
That is high margin, beautiful revenue. That is the premium product. It's basically a luxury good in the world of payments.
Right. That's the golden goose. That's the part of the business you want to see growing. But looking at the recent earnings reports, that is not where the volume growth is coming from anymore, is it?
No, and that's the absolute core of the problem here. The mix shift is toxic. The growth we are seeing in the headline numbers, the total payment volume, it's largely driven by Braintree.
And Braintree is their other business, the one people don't really see.
Exactly. Braintree is their unbranded processing arm. It's the plumbing behind the scenes for companies like Uber or Airbnb. Now, volume-wise, that sounds amazing. Look, we process for Uber.
Yeah, that sounds like a great selling point.
It does, but the take rate on Braintree is totally commoditized. We are talking about maybe 0.5% to, if they're lucky, 0.8%.
Okay, so let me get this straight. For every $100 processed on the classic PayPal button, they were keeping about $2.50. But for every $100 processed through Braintree for, say, Uber, they're only keeping maybe 60 cents.
That's it. So they are trading $1 of revenue that costs them very little to generate the branded button for $1 of revenue that comes with a much, much smaller profit margin.
They are swapping diamonds for coal, essentially, just to keep the top-line revenue number looking like it's still growing.
It's actually worse than that. It's what we call empty calories. You'll hear the bulls and they'll say, but isn't volume growing? Total payment volume is up. And sure, the volume is up, but they are suffering from the Red Queen effect.
I love that mental model. This is from Alice in Wonderland, right? The Red Queen says to Alice, now here, you see it takes all the running you can do to keep in the same place.
Precisely. That is PayPal right now. They are running faster and faster processing, significantly more low-margin volume via Braintree, just to generate the same gross profit dollars they used to get effortlessly from branded checkout.
So they're working harder for the same amount of profit.
They are running to stay still. And the terrifying part for an investor is they don't have the pricing power to fix it.
That's a key point. Usually when you have a dominant network, you can raise prices. I mean, Visa does it, MasterCard does it. They raise the interchange fee, merchants complain, but they pay it because they have to. Why can't PayPal just hike the fees on Braintree?
Because of the competition. It's that simple. On the unbranded side, you have Adyen and Strike breathing down their necks. Those are ferocious competitors with, frankly, better technology stacks.
So if PayPal tries to raise fees...
If PayPal tries to raise fees on a massive merchant like Uber, Uber will just say, okay, see you later, and switch to Adyen tomorrow. The switching costs just aren't high enough to protect PayPal.
And on the consumer side, they tried to fix this, didn't they, with the Fastlane initiative?
Right, Fastlane. This was a big pitch recently. The idea was to use guest checkout data to speed up transactions. It sounded good on paper, recognize the user, autofill the info, get the sale done faster.
Seemed logical.
It did sound good. But adoption has been really slow. And it's slow because they are fighting against what Charlie Munger would have called a Lollapalooza effect, a confluence of forces creating a massive outcome.
But in this case, it's a negative Lollapalooza.
A massively negative one. And the biggest factor in that storm is what I've started calling the anti-moat.
The anti-moat. Okay, this is where it gets really interesting. We always look for companies with wide moats, durable competitive advantages. You're saying PayPal has the opposite.
I am. And its name is Apple.
Apple Pay.
Apple Pay, we'd have to really sit with the structural disadvantage here. I mean, just think about the positioning. Apple sits at the operating system level. They control the hardware in your hand. PayPal is just software and app. Apple is upstream of PayPal.
So if I'm holding my iPhone and I want to buy a coffee or a pair of shoes online, walk me through the friction. Compare the two experiences.
Sure. If you use Apple Pay, you double-click the side button on your phone. Face ID scans your face. And you're done. The payment is made. It is physical. It is integrated into the device itself.
Instantaneous.
Right. Now, what happens if you want to use PayPal? You have to unlock the phone. You have to open the browser or the retailer's app. You have to scroll down and find and click the PayPal button. Maybe it remembers you. Maybe it asks for a password or a two-factor authentication code.
It is the path of resistance versus the path of least resistance.
Exactly. That is the definition of convenience bias. And human beings will always, always choose the path of least resistance. Face ID is hardware. It's instant. PayPal requires a login. You cannot copy the advantage of owning the hardware unless you build your own phone, which PayPal is, obviously not going to do.
And we are seeing this play out in the data, aren't we? This isn't just a theory anymore.
No, it's very real. We finally got the inversion signal in the Q4 25 numbers. This was the moment the alarm bell should have gone off for every single investor. Branded checkout. The golden goose grew only 1%.
1%. I mean, with inflation running at 2 to 3% and e-commerce generally growing at, 8 to 10%?
Exactly. That implies it is shrinking in real terms. That is effectively stalling. That is the core profit engine of this entire company sputtering out. When you see branded checkout growth decouple that severely from overall e-commerce growth, you know you have a deep structural problem.
They're losing market share.
They are hemorrhaging market share, specifically to Apple Pay.
And it's not just the technology, is it? There's a demographic shift, too. I was reading about the social proof aspect of this. Gen Z just doesn't look at PayPal the same way millennials or Gen X do.
No, they don't. To a Gen Z user, PayPal feels like a legacy bank. It feels
corporate, old. They live in a world of Apple Cash and, ironically, Venmo.
Right, their own product. Their own product, but, and this is so crucial, they don't associate Venmo with the corporate PayPal branding. They see it as its own thing. And they prefer the native OS integration of Apple. So you have a demographic headwind combined with a massive technological disadvantage. That is a very, very difficult position to be in.
Okay, so the engine is sputtering, the margins are degrading, there's a predator in the water named Apple that owns the hardware.
Yeah.
In a situation like this, you need strong, visionary leadership to steer the ship.
You need a wartime CEO.
You need a genius.
Oh.
Which brings us to pillar number 2, the leadership vacuum.
Or as I like to call it, the revolving door.
It has been chaotic. I mean, let's just look at the timeline. It's February 2026. We just saw the abrupt departure of CEO Alex Chriss. He was supposed to be the savior, right? He came in September 2023.
Yeah.
He lasted about 2.5 years.
Yeah.
That is not a vote of confidence.
And frankly, his departure is a massive red flag. When a CEO leaves that quickly, especially one who was brought in specifically to execute a turnaround, it suggests one of two things. Either there was deep fundamental misalignment with the board, or he looked under the hood, saw the engine block was cracked beyond repair, and just decided to bail. Neither one of those is good.
No, both are terrible. But what's even more concerning to me is the replacement. Enrique Lores.
Right. Formerly of HP.
Hewlett-Packard. The printer and laptop company.
Now, I don't want to attack the man personally. By all accounts, he's a very competent executive. But this is a classic textbook example of the institutional imperative at work.
Explain that concept for the listeners. I think it's a really important one.
It's a concept Warren Buffett talks about all the time. It basically means that when large organizations get scared or they don't know what to do, they revert to safe mimicry. They do what looks right, not what is right. The board at PayPal is scared. The stock is tanking, so what do? Do they go out and hire a young, hungry fintech visionary who understands crypto, decentralized finance, and the future of payment rails?
No. That would be risky.
Exactly. They hire a safe pair of hands. They hire a hardware veteran, someone who knows how to cut costs and manage a slowly declining asset like printers. It just screams defensive.
It signals that the board doesn't have an innovative direction. They just want to stabilize the bleeding.
That's the signal. It feels like a massive mismatch. You're fighting a software war against Apple and Stripe, and you bring in a hardware supply chain expert to lead the charge.
I can only imagine what the culture inside PayPal must feel like right now.
From what we can gather via, Glassdoor reviews and insider sentiment, the culture is in shock. You have to remember, this place used to be the place to work in Silicon Valley.
The PayPal Mafia.
The PayPal Mafia. Elon Musk, Peter Thiel, Reid Hoffman, that innovative DNA is long, long gone. Now it's a massive corporate bureaucracy that just lost its leader again. Innovation is completely paralyzed because nobody knows if the new boss is going to come in and kill their project in 6 months.
And then there's Venmo. We touched on it briefly, but Venmo is this strange beast, isn't it? It has an incredibly high NPS Net Promoter Score. People love Venmo. I use it, you use it.
Everyone uses it.
But they still haven't figured out how to make real money from it.
That's the great tragedy of Venmo. It's a wonderfully sticky product with almost zero monetization capability relative to its massive user base. They've tried credit cards, they've tried crypto features, they've tried pay with Venmo at checkout.
And none of it has really worked.
It just hasn't moved the consolidated needle. It's an asset that is loved by users, but mostly ignored by the P&L statement. It's basically a public utility at this point, great for society, bad for the shareholders.
So let's just recap where we are. We have a broken business engine, a terrifying competitor in Apple, and a leadership team that looks like they're playing defense, not offense.
Yeah, that about sums it up.
If I stop the deep dive right here, everyone listening is going to go short the stock immediately. It sounds like an absolute disaster.
It certainly looks that way from a qualitative perspective. The story is. It's ugly.
But, and this is a huge but, here's where it gets really interesting. We have to look at the other side of the coin, because despite everything we just said, this company is generating an obscene amount of cash.
This is the cognitive dissonance of PayPal.
Yeah.
The whole puzzle. If you look at the P&L, it's ugly. If you look at the cash flow statement, it's beautiful. Even with the margin compression, even with the management chaos, PayPal is an absolute cash cow.
Which brings us perfectly to pillar number 3, the Cannibal math.
Yeah.
Because this is the entire bull case.
Right. We mentioned the PE ratio is a low 7.5x. But savvy investors know that earnings can be manipulated. Cash is fact. What we need to look at is the free cash flow yield.
And if you adjust for stock-based compensation, which, by the way, has been a drag for years, but they are finally getting more disciplined with it, the free cash flow yield is effectively sitting between 10 and 12% at these prices.
Okay, so for the non-finance nerds out there, explain why a 10 to 12% yield matters so much. Why should they care?
Think of it like a rental property. If you buy a house for $100,000, and after all your expenses, mortgage, taxes, repairs, it puts $10,000 or $12,000 cash in your pocket every single year, that is a 10 to 12% yield. That is a phenomenal return.
Most real estate investors would kill for that.
They'd do anything for that. And that assumes the rent never goes up. It means that if you bought the entire company today and took it private and it didn't grow a single dollar from here on out. It would pay for itself in less than 10 years just from the cash it has in the register.
That provides a massive floor under the stock price. It is very hard for a stock to go much lower when it is spitting out that much cash.
And they aren't just sitting on that cash, are they? They are doing something very specific with it. They are becoming cannibals. And in the investing world, being a cannibal is a very, very good thing.
It is the best thing you can possibly be when your stock is this undervalued. A cannibal is a company that aggressively eats its own shares. It buys them back from the open market.
And in the last year alone, PayPal reduced its share count by 6.8%.
That is huge. Nearly 7% of the entire company just gone in 1 year.
It's massive. And here is the math that the bears often miss, or maybe choose to ignore. We call it accretive buybacks.
Right.
When you buy back your own stock at a 7.5x PE, that purchase is highly accretive. They are effectively buying $1 of their own earnings for just $7.50. As long as the business doesn't actually go to zero, that is a phenomenal return on their capital.
So let me just spell this out. Even if the actual business doesn't grow, even if revenue is totally flat, my slice of the pie gets bigger every year because they are removing the other slices from the table.
Exactly. You own a larger and larger percentage of the company's cash flow without paying an extra dime for it.
It's a powerful force.
And then there's the dividend. This was a new development. They recently initiated a dividend of 14 cents per quarter.
Which was a surprise to many, I think.
It was. What does that signal to you? A tech company paying a dividend usually means the big growth party is over. You don't see Tesla paying a dividend. You don't see Amazon paying a dividend.
It absolutely signals maturity, and frankly, it is a capitulation. They are admitting implicitly that they cannot reinvest that capital internally at a high return on invested capital, or ROIC.
So they're basically saying,
They are saying, look, we don't have any brilliant acquisitions to make. We don't have a new R&D project that needs billions of dollars. So here, just take the money back. It marks the transition from a compounder, a company that grows by reinvesting, to a cash cow, a company that just exists to return capital to its owners.
which is a very different kind of investment. And that brings us perfectly to pillar number 4, valuation and the reverse DCF.
Yeah.
We need to figure out what the market is actually telling us at this $40 price point.
Right. So let's get a little technical, but keep it really simple. A DCF, a discounted cash flow, is how Wall Street traditionally values companies. You project future cash flows out for years and then discount them back to what they're worth today.
But that involves a lot of guessing about the future, which is notoriously hard.
Exactly. It's often garbage in and garbage out. So we prefer to use a reverse DCF. We look at the current price and we ask, what assumptions do I need to believe to justify this price? We work backward from the answer.
So what is the market assuming at $40.42?
At $40, trading at 7.5x earnings, the market is pricing in a permanent secular decline. The market is saying that PayPal's earnings will shrink by roughly 2 to 5% every single year forever, into perpetuity.
That feels incredibly pessimistic. I mean, e-commerce is still growing. Digital payments are still a growing market. Even if they lose share, to shrink by 5% forever seems harsh.
It is extremely pessimistic. And that's where the flatline wager comes in. This is the core thesis for the value investor. Let's assume the bears are half right. Let's just assume PayPal never grows its revenue again. 0% real growth. A flatline.
Okay, so revenue is flat. We'll assume expenses are flat too.
But they continue to use their massive free cash flow to buy back 6% of their shares annually, which they are already doing.
So revenue is flat, but the share count drops by 6% every year.
That means your earnings per share, or EPS, grows at 6%. Mathematically, it has to, because you have the same amount of earnings divided by fewer and fewer shares.
So you end up with a stock that is trading at 7.5 times earnings that is actually growing its EPS at 6%.
That is objectively mispriced. I mean, a company growing EPS at 6%, even a boring one, usually trades at 12 or maybe 15 times earnings, not 7.5.
So there's a massive disconnect. The market is pricing it for a painful death, but the math says even just stagnation creates value for shareholders.
That's the value proposition.
So what is the stock actually worth? Let's try to triangulate a price target. What are the different ways to look at it?
Okay, if we triangulate the value, we get a few different numbers. Method A is simple mean reversion. Let's say the sentiment shifts just a little bit. If the new CEO comes out and just gives one decent earnings call, and the stock re-rates to a very modest 12x PE.
Which is still well below the S&P 500 market average of like 20x.
Right, not asking for much.
Yeah.
At a 12x multiple, the stock goes to somewhere between $65 and $75. That's almost a double from here.
Okay, that's the optimistic view. What's a more conservative floor?
Method B is what we'd call owner earnings. If we assume zero growth forever, and we just capitalize the current free cash flow of roughly $5.40 per share, the intrinsic value is around $54.
So even with absolute zero growth assumptions forever, it's trading at a 35% discount to its stopped clock value.
Correct. And then you have method C, which is the analyst consensus. The average on Wall Street is sitting at around $63.72. But I would warn the listener, Wall Street is very slow to downgrade. They often chase the price down. So take that $63 number with a big grain of salt.
Okay, so the math looks compelling. It looks cheap. But we aren't just doing math here, we're assessing risk. Because there is a scenario where this doesn't just flatline, it collapses. So let's talk about the nightmare scenario, Pillar 5, risks and meat, the final verdict.
The biggest risk, the one that keeps you up at night if you own this, is the BlackBerry trap.
Oof. Comparing anything to BlackBerry is never a good sign.
No, but think about BlackBerry in, say, 2010. They had huge sales volume, they had loyal corporate customers, they had cash on the balance sheet, but the network effects that built them started to work in reverse. Once people started leaving for the iPhone, the value of the BlackBerry network collapsed exponentially.
And for PayPal, the risk is that branded checkout doesn't just grow slow. It starts to shrink rapidly as everyone moves to Apple Pay.
It's an implosion of operating leverage. If your high-margin revenue, the branded checkout button, disappears, your profits collapse much, much faster than your revenue does.
Why is that?
Because the fixed costs, the servers, the thousands of engineers, the compliance department, all of that stays the same. If that high-margin cream is skimmed off the top, you are left with the low-margin Braintree business, which might barely cover the company's fixed costs. That is the trap.
So profits could just vanish.
If that happens, the buybacks don't matter because the cash flow that funds them dries up.
So the cannibal eats itself until it starves to death.
Exactly. And on top of that, we have the regulators. They always seem to be lurking around payment processors, don't they?
Yeah, the CFPB in the US and the EU regulators seem to always be looking at this space.
They're constantly looking at interchange fees and what they call junk fees. A huge, and I mean huge, profit center for PayPal is cross-border transactions. The fees they charge when you buy something in euros with your US dollar account, it's basically free money for them.
And if regulators decide to cap those fees,
that is instant profit destruction. There is no getting that back. It's just gone overnight.
So we have the cannibal math fighting against the BlackBerry trap. It's a battle between financial engineering and product obsolescence. So give it to us straight. Let's synthesize all of this.
Okay. If I have to give it a quality score, it's low to medium. The moat has clearly been breached. The management is unstable. This is not a sleep well at night kind of holding.
Right.
However, if I give it a valuation score, it is deep value. It is priced for death. And I just don't think it is going to die that fast.
So what's the final thesis? Summarize the bull and bear case for us one last time.
Okay. The bull case is that the cannibal math works. It's that simple. Even with zero top-line growth, the buybacks drive EPS, and the stock is simply too cheap to ignore. The market eventually realizes this, re-rates it to a 12x multiple, and you double your money.
And the bear case?
The bear case is that it's a classic value trap. Branded checkout is dying a faster-than-expected death. Enrique Lores is the wrong CEO to fix it. Operating leverage reverses violently, and the next stop for the stock is $30.
And where do we land after all this?
Yeah.
Is it a buy?
It is a buy, but, and this is a massive, bold, italicized, but it is not a long-term compounder. You were not buying this to hold for 10 years like you would hold an Amazon or a Microsoft. This is a cigar butt trade.
Explain cigar butt one more time for the folks in the back. It's such a great analogy.
It's an old Ben Graham term. You're walking down the street and you find a cigar butt on the pavement. It's gross, it's soggy, but you notice it has one good puff left in it, and it's free. So you pick it up, take that one puff, that's your profit, and then you throw it away.
You don't put the soggy cigar butt in your pocket and take it home to your family.
No, you buy this for the mean reversion.
Yeah.
You buy it for the bounce back to a more realistic valuation.
So what is the buy zone? Where should people be looking?
The buy zone, in our view, is between $38 and $42. We are currently right in the middle of it. But you have to be disciplined. If this stock pops to $60 on some good news, you sell.
You take the profit.
You take the profit, you don't fall in love with it, you thank the market for the gift, and you move on to the next idea.
That is a crucial distinction. This is a trade, not a marriage.
Precisely. Do not get attached to this company. The fundamentals are deteriorating, even if the current price is very attractive.
So what does this all mean for you listening right now? If you buy PayPal today, realize what you were doing. You aren't betting on the future of payments. You aren't betting on innovation. You certainly aren't betting that they're going to beat Apple.
No. You are making a much colder, more calculated bet. You are betting that the company dies slower than the market currently thinks it will.
That's the reality of it. It's a grim bet, but it's a potentially profitable one.
It is the arbitrage of pessimism. That's all it is.
So I will leave you with this final provocative thought to chew on. Are you comfortable holding a melting ice cube just because you bought it at a discount?
Yeah.
Because that is effectively the wager you are placing.
It's a dangerous game, but right now the odds might just be in your favor.
Thank you so much for tuning into this deep dive on synaptic investing. We hope this helped clarify the battleground that is PayPal.
Thanks for listening. Do your own diligence, check out the links, and we'll see you in the next one.
Bye for now.